Welcome to this Monday edition of Inside India. I'm Sri Jegarajah. Let's get you across today's headlines. President Trump threatens 30% tariffs on EU and Mexican imports. The EU will now be holding off on countermeasures till August the 1st, while other trading partners, including India, race to do deals by the end of the month. Investors will also be focused on inflation prints this week. India due out with its CPI data today, ahead of the US later in the week. And US trading firm Jane Street said to have deposited over $500 million in an escrow account as required by regulators. Welcome to the programme. Let's take a look at the bigger picture in terms of the action on the regional markets. So Wall Street did struggle on Friday, so that's what we are inheriting. So the regional markets out here, somewhat muted, subdued, somewhat directionless. 30% tariffs, as we said, on imports from the EU and Mexico from August the 1st. That's the latest from President Trump, even though both of those countries are locked in negotiations. Tariffs then continue to bully these markets. And then, of course, we have S&P Q2 earnings kicking off this week with the banks. So markets will have to get their heads around that, and especially the guidance in this era of uncertainty. Expect growth in S&P earnings, but at a much slower pace than prior quarters, single digits compared to double digits. US futures with that pointing to a lower start when Wall Street reopens tonight. This as US President Trump continues to raise the temperature and up his tariff campaign. He's threatened duties of 30% on both the EU and Mexico starting from August the 1st. For Mexico, these tariffs will be on goods that aren't already subject to sectoral tariffs, like autos and copper, and goods that don't come under the current USMCA deal. Both countries say they'll continue negotiations with the US to get a lower rate by next month.
We have always been very clear that we prefer a negotiated solution. This remains the case, and we will use the time that we have now till the 1st of August. And on the second track, since the very beginning, we have worked and now are ready to respond with countermeasures. We've prepared for this, and we can respond with countermeasures if necessary.
We believe, based on what our colleagues discussed yesterday, that we will reach an agreement with the USA and that we will, of course, achieve better conditions.
China's trade figures just crossing the wires. Elaine Yu joins us with the breakdown. Good morning, Elaine. It seems to be a story of resilience with these trade numbers, despite all the uncertainty related to tariffs.
That's right, and we are seeing exports beating estimates with the June data just came out, and export growth has accelerated last month with exports from China rising 5.8%. That's beating estimates of 5% and compared to the previous month's 4.8%. So that is because American tariffs on Chinese goods were brought down after the trade truce was struck in Geneva in May. And that was cut back from as high as 145% to 55%. So China's customs spokesperson said U.S.-China trade has recently shown signs of recovery, and we should be able to attribute that to the effect of lower tariffs. And imports in June also rose in China, and that also points to consumption that has been more resilient than expected as well in China in the last few months, with all these subsidies supporting domestic consumption and also shopping festivals and so forth.
Elaine, thank you very much indeed for that. We appreciate it. Elaine Yu there on the latest China data. Now, the Indian markets join us in about 45 minutes' time. Here's what GIFT Nifty futures are indicating. 25,193, so little changed compared to where we left off on Friday. Dollar-rupee exchange rate just below 86, actually, 85.932. Some latest developments in the Jane Street case. The US trading firm has deposited the $567 million as required by the Indian regulator in an escrow account, according to India's money control. While this means it would allow it to resume trading activity in the Indian market, it's unclear if it will do so. And we are watching out for India's inflation numbers for June, due later today. Reuters poll suggests headline CPI may have dropped to a 6-year low of 2.5%, helped by a bumper spring harvest that's kept food prices in check. This would mark the longest streak where inflation has been below the RBI's target range of 4 to 6%. Meanwhile, wholesale inflation could edge higher. Analysts polled by Reuters expect it to come in slightly hotter than last month at 0.5% compared to the 0.39% in May. Meantime, tax collection in India is showing a slight dip. Between April and July the 10th, net direct tax collection fell 1.3% to 5.6 trillion rupees. That's mostly due to a surge in refunds issued by the Indian government. Government paid out 1 trillion rupees in tax refunds during this period. That's 38% more than last year. Let's get more on the outlook for India's economy and with particular reference to the inflation print. Anubhati Sahay, head of India Economics Research at Standard Chartered Bank, joins us now. Anu, thank you very much indeed for joining me on the programme. What's your take on what to expect from the latest inflation print and therefore the implications for the RBI's policy path?
Sure. So I think when we are looking at inflation, this will be the 5th month in succession where we'll see inflation less than the medium-term target of 4%, which is mandated for the MPC. Our forecast for June CPI is at 2.4%, and that would be primarily driven by very subdued food and beverages inflation. In fact, this is quite a, on a YOY basis, this will be one of the first months after several, quarters where we will see the food inflation, just the food inflation actually dipping into the deflationary territory. Core might be slightly stronger, primarily just as a reflection of gold prices. Gold prices were higher during June, and that will get reflected. But overall, the inflation outlook remains extremely benign, driven by extremely subdued food prices, good monsoon, and prospects of good crop even going forward.
What, therefore, Anu, is the RBI's next move when they meet in early August, given the conditions?
I think Sure. When it is about early August, given that MPC has already front-loaded its action, both in terms of repo rate cut. In the June policy meeting, we saw 50 basis points of rate cut. They have already announced in advance liquidity injection via 100 basis point CRR cut from September onwards. August, to that extent, in our view, will thus be a status quo. In fact, that was very explicitly mentioned by the RBI governor. Going forward, our view is that RBI is likely to keep repo rate at 5.5%, but there is a risk that some room might open up later in the year for 1 or 2 more rate cuts if inflation continues to surprise on the downside. Our forecast for full year, FY26 CPI is at 3.5%, and if inflation, say, surprises even lower, and especially with respect to MPC's forecast of 3.7%, then maybe there can be a room for 1 or 2 more rate cuts. But probably we will have to still await more clarity on how monsoon progresses. We are still in the middle of the season. 1 or 2 weeks of bad weather can have a massive impact on food prices, especially perishables. So yes, there is a risk of 1 or 2 more rate cuts, but probably we will have to await a little bit more clarity on food prices before we draw that conclusion very firmly.
Anu, in terms of the underlying economic picture, to me, something doesn't quite add up, and that's because we are witnessing slower earnings growth at a corporate level. What is that telling us about macroeconomic conditions? Is that telling us the whole story? And does that imply that 6.6% headline GDP for the current fiscal may be perhaps overstated?
I think for India, 6.5 to 6.6% GDP is pretty much achievable when we are looking at the current financial year, that is FY26. You're right that corporate earnings are showing signs of softness, but when we are looking at the GDP, there are various other factors which play an equally important role, if not less. For instance, if we're looking at the current financial year, agricultural output. We have got a very, very good output in the last winter crop. And the next two crops also look promising at this point in time. That should be supportive of rural demand. And while corporate earnings might be under pressure, probably going forward, we might see some improvement in consumption demand. Our view is that overall, consumption in India is likely to get some support going forward on back of two counter-cyclical measures which the government and the RBI have pushed together. The impact is yet to be felt. And if I have to quantify, 0.6% of GDP worth of counter-cyclical support has been given, especially to the urban consumers, in terms of tax cuts, in terms of 100 basis points of rate cuts. And that should start showing up in numbers going into the second quarter of fiscal year 26. Rural demand should get a boost both from good crop, lower inflation, and public expenditure is picking up. Private investment will remain missing. But when we add it up all together, along with a benign inflationary environment, both driven by food prices as well as lower global commodity prices, I think 6.5, 6.6 is, pretty much achievable for India.
Understood. Anu, I've got to say, though, isn't there a dilemma here when you consider the work that needs to be done to get to a US-India trade deal? We know that agriculture is a big roadblock. And as you quite rightly pointed out, domestically, the rural economy, tier 3, tier 4, tier 5 cities, they are performing strongly. The government will not want to jeopardize that under a trade deal that allows greater market access for US farm goods that could undermine that story domestically. So how do they thread that needle?
It will be extremely challenging. And as we are seeing with most of the countries, even, over the weekend, what we heard about a 30% tariff been imposed on EU, chalking out a trade deal which suits both India as well as US, US ask list will be extremely, will be watched out very, very carefully. Having said that, there are a few ways in which it can still be done. I think while it's always difficult to, make a list of expectation on how the trade deal would look like, but probably given the way tariffs have come for most of the economies, I think India also might end up with a slightly higher tariff than what was the expectation before. Previously, we thought a 10 to 15% tariff, maybe that range has shifted higher. As far as agriculture and dairy are concerned, or even some other sensitive sectors from in a government of India's perspective, maybe the government will have, they have been pretty open, but maybe they will have to carve out a little space in terms of providing access, but only for products which would impact a very, high-end income, not the lower end, because it's politically difficult to open up agriculture fully for exports from the US.
So how confident are you of a early harvest, pardon the pun, a short-term trade deal that kicks the more challenging issues, if you will, further down the line, down to September, October, and there's an agreement to ease market access, as you mentioned, for select agricultural products and not areas like dairy and genetically modified grains that are proving so controversial?
So obviously our hopes have been pretty high since last 2-3 months. But of course, we will have to wait how things really pan out. But one positive aspect of this whole negotiation has been that we have not heard on a tariff level. Negotiations are still ongoing. And whatever India has put forward has not, at least publicly, seen a negative comment from the US official. So we still think there is a possibility of a trade deal, interim trade deal before August 1st. But of course, the contours will need to be watched out very, very carefully.
Should India be worried about a 10% BRICS tax?
Well, the aggregate tariff rates will matter. So yeah, if it is, if that tax, if it gets an additional 10% tax, which puts India at a disadvantage versus other peer economies, then yes, it's a burden. But if it still leaves tariff cap in favor of India, then that should still be manageable. On an absolute basis, there is a net loss for GDP. There is absolutely no doubt about it. But the overall impact would depend on what is the relative tariff gap with the rest of the world.
There are a lot of good news stories happening on the trade front. That India has been tireless in finalising a UK-India deal, an EU-India deal. There is this momentum with the GCC corridor with India, with Southeast Asia. There's the BRICS. At what point, Anu, is all of that going to translate into perhaps an FDI windfall, inflows, and economic tailwinds? Is it going to be drip feed into the economy, or is there going to be some sort of big bang? How would you characterise the net positive impact?
So overall, if we look at the kind of push which is there in order to sign as many trade deals as possible, as you very rightly mentioned, we were not very optimistic on EU trade deal when signed quickly, but it seems it's progressing very well. India-UK FTA, at least the interim one, is already in place, and maybe we'll see the final deal by next year. Now, let's break it down stage-wise. I think, one, because India's tariff rates are higher than all the peer economies, US, UK, or EU, the first stage impact on India will be negative because the trade surplus which India runs with all these economies will narrow down. So the first stage impact is likely to be negative. The second stage impact, however, can definitely be positive, given that there are certain sectors for which India is batting. For instance, textile is one segment where probably India is trying to get a 0% duty for markets in UK, EU, as well as US. And if that happens, then textile sector can get a tailwind. The other part which we'll have to watch out is, even if India gives concessional tariff rates for all exports coming out of all these three economies into the country, where would these lower tariffed goods would find its way? For instance, if we look at South Korea, Japan, they got much lower duties for their products, something like steel, but that finally found its way into the auto sector and laid the groundwork for a very robust auto industry in the country. So I think it will be positive. The government is trying to figure out ways to make it win-win for both sides. Yes. So we'll have to wait for the contours to come out and get more details. But few sectors clearly seem to be winner in the near term. First stage impact will be negative.
Thank you for that, Anu. And just very finally, what sort of progress do you feel the government is making in addressing the structural economic issues, not least of all, job creation? Because we've seen unrest unfolding, haven't we, in the form of the nationwide Bharat Bandh protests that they are already underway. Is all of this going to culminate in the Bihar state elections in October, November? And how much of a challenge is this going to be for the administration?
When we're talking about challenges like job creation, I think this will run through several years. It's very difficult to push out policy measures which can address a complicated issue like job creation very quickly. In terms of number of jobs, yes, 10 to 12 million jobs are being created. But the government really has to put in a lot more efforts in order to create higher, more productive jobs. A bulk of the jobs have been created in self-employed sector where earnings are less than what one would get in a salaried job. So skilling, education, expanding the manufacturing base by easing the land and labor, all these measures will have to be taken. There are a few positive signs. For instance, the semicon tie-up which India and Taiwan has done. There are a lot of OSATs which are coming up. GCCs are doing, very well. But of course, this has to be done at a much more accelerated manner in order to create the high-quality jobs which India India needs to reap the demographic dividend. For political side, we are still a little bit away, but we'll have to see how it plays out. But lower inflation, etc., are positives, which one also needs to keep in consideration.
And we'll leave it there. Thank you very much indeed for your analysis on India's macroeconomic conditions and expectations for inflation. And with the Sahay there from Standard Chartered Bank. Now, a preliminary report into last month's Air India crash has been released. The Aircraft Accident Investigation Bureau says there was confusion over the plane's engine fuel switches, likely causing both the engines of the Boeing 787 to shut down mid-flight. The switches were found in the cut-off position, with the report finding they had been almost simultaneously flipped after takeoff, but it's still unclear how that happened. Separately, Boeing and the US Federal Aviation Administration issued notifications saying the fuel switch locks on Boeing planes are safe. The AAIB report also describes cockpit confusion moments before the crash that took 297 lives, with one pilot asking the other, "Why did you cut off the fuel?" and the other replying that he did not. India's Civil Aviation Minister defended the crew as scrutiny over pilot actions grows.
I don't think we should jump into any conclusions on this. I truly believe we have the most wonderful workforce in terms of pilots and the crew in the whole world. I have to appreciate all the efforts the pilots and the crew in this country are putting into the aviation. They are the backbone of this civil aviation. They are the primary resource of civil aviation, and we care for the welfare and the well-being of our pilots also. So let's not jump to any conclusions at this stage. Let us wait for the final report.
Before we head to a break, let's take a look at Bitcoin. And these are the latest quotes. Just in the last 1 year, the cryptocurrency is up nearly 100%. Bitcoin there on your screen, close to 120,000. Inside India, we'll be right back in 2 minutes. Welcome back to Inside India. India's Foreign Minister S. Jaishankar is heading to China this week to attend the Shanghai Cooperation Organization Summit. This is his first visit to China in years and comes amid delicate ties between New Delhi and Beijing. Talks are expected to focus on regional security, trade and stronger cooperation within the 8-member SCO bloc. This is also the second recent visit to China by a senior Indian minister. Just last month, Indian Defence Minister was in China for the SCO Defence Ministers meeting, where he refused to sign the joint statement. Interesting. Australian Prime Minister Anthony Albanese is also in China. Elaine Yu is back to give us the details. Elaine, is this all about resetting relationships?
That's right. Albanese was the first Australian leader to visit China in 7 years, 2 years ago. So this is now his second visit. So his term is really marked by improving ties, especially during these times of global trade turbulence. And China-Australia trade ties are really built on mutual dependence. When Albanese landed in Shanghai, he said 1 in 4 jobs in Australia depends on exports, and exports to China is worth more in value than the next 4 countries combined. And now China is also reliant on Australia's iron ore to fuel its industrial engine and to manufacture its exports. And now Albanese has also said he pledges to work with China to address global excess steel capacity after complaints from various countries about the flood of Chinese steel. Now, looming over these improving ties is the U.S. reportedly pressuring Japan and Australia on what their role would be if a war would break out between China and the U.S. over Taiwan. And Evan Feigenbaum, a former U.S. official, made an interesting comment earlier about the balancing act between the U.S., China, and Australia. Let's take a listen.
Mr. Trump is very unpopular in Australia, so Prime Minister Albanese loses nothing politically by pushing back in public. And not surprisingly, that's exactly what he's been doing. So the U.S. risks overplaying its hand with its closest allies in ways that will have blowback and get to a worse place than we are now.
And he also added that this would put countries like India, Australia, and Japan in a tricky position. Back to you, Sri.
Great work, Elaine. Thank you very much indeed for that. Coming up on the programme, earnings season has kicked off in India. We will bring you a preview of what's expected after this short break. Welcome back. India's trade talks with Australia hitting a roadblock. New Delhi reportedly rejecting Canberra's demands of deeper tax cuts in dairy and wine. The two countries had signed an interim trade deal in 2022, lowering some tariffs, but a final agreement covering goods, services and visas has still not been reached. India has been closely guarding its dairy sector in trade talks with the United States as well. Despite the impasse, both sides say they're still hopeful, with India open to cuts on industrial goods and seeking more visas and services access. Back to the markets. We are counting down to the open of the benchmark in India. This is how we are shaping up. Let's give you a glimpse at futures 15 minutes away from a trading day. Nifty futures 25,197, let's call it 25,200. So we are looking at an incline, a very modest one at that, of about 50 points for the benchmark Nifty 50, which closed off on Friday at 25,149 and change. Bear in mind, we do have inflation data, so that's really going to inform the market action. And if it does come in on the cooler side, then that's going to be a positive for the broader market, as it has been for quite some time, given the favourable monsoon rains and the benefits that we've been talking about to the broader rural economy. Dollar-rupee exchange rate just has now crossed 86. So we are seeing some weakness for the Indian currency. And there's a debutante in the markets today. That's Travel Food Services will be listing on the Mumbai exchanges in less than an hour. The airport, restaurant and lounge operator saw strong demand for its $234 million IPO. Institutional investors bid aggressively, nearly 8 times the shares reserved for them, while retail investors, more cautious, bidding just 0.7 times. Shares are priced between 1,045 and 1,100 rupees. Travel Food Services is among India's top 10 public offers this year, aiming for a valuation of around $1.7 billion. We will be speaking to the company's CEO tomorrow on this programme. Don't miss that exclusive conversation with Varun Kapoor, Travel Food Services CEO. We'll also be watching shares of HCL Tech today. IT services giant reports its quarterly earnings later this evening. Analysts expect tariff-related uncertainties to weigh on the company's performance last quarter and in the near term. Profit growth is likely to stay muted, but investors will be watching the deal pipeline closely. Last Friday, rival TCS also flagged macroeconomic headwinds as it posted a weak first quarter. Let's get more on the Indian market and the outlook and bring in VK Vijayakumar, Chief Investment Strategist at Geojit Financial Services. VK, thank you very much indeed for joining me, sir. First of all, why should we expect only modest returns, and why do you believe there is no scope for a sustained rally this year?
Thank you for having me here on the show today. Our expectations are modest this year, this financial year, because two major sectors of the market, the IT services sector and the consumer sector, are struggling. The IT services sector, as is well known, is struggling mainly because of the poor execution of the orders from the US. The US economy also is slowing down. Therefore, the orders from the US are not getting executed. It is getting on hold. And therefore, there is only single-digit revenue growth this year, and the management commentary from the TCS results also is not very optimistic. So a major earnings segment is struggling. That is one of the reasons. The second is consumption also has been weak after some 3 years of very impressive growth. Urban consumption has been particularly weak. We are witnessing green shoots of consumption revival in the last couple of months. Perhaps it may sustain, but then a sharp recovery in consumption is not expected in the first 2 quarters of this financial year. We expect a recovery from the second half of this financial year onwards.
VK, I'm surprised to hear you say that consumption is struggling when we have a very strong rural economy segment that's benefited from the favourable monsoon rains. Farm incomes have been rising. Yes, it is in question if there is a trade deal with the US that allows for greater US market access on farm goods. But we also have other positive themes around the consumer, that is quick commerce, the premiumisation of the consumer. I fail to see why the consumer sector is in so much trouble. So just help me out there.
Well, segments of consumption like the quick commerce, as you mentioned, all the premium segments are doing well, not just in retail, quick commerce, but also in segments of automobiles. There is a vibrant activity, and also in premium hotels, they are doing well. But in FMCG, fast-moving consumer goods, the volume growth has been tepid for more than 2 years from now. Of course, we are witnessing some pickup there, and the positive effect of good monsoons will take perhaps one more quarter to show results. Yes. Premium consumption is doing well. So broadly speaking, domestic consumption themes, sectors driven by domestic consumption, not only this, but also segments like telecom, aviation, premium hotels, as we discussed, premium segments of automobiles. These are all doing well, but FMCG is not witnessing any significant volume growth. So that is an area of concern.
VK, we do have inflation prints, CPI data this week. If they are favourable and if they continue to show that inflation is under control, what are the implications for the RBI and their meeting in August, in early August? And is that going to give a boost to the broader market?
Well, the RBI, the Monetary Policy Committee, has already front-loaded the rate cuts. They have already cut the rates by 100 basis points in this rate-cutting cycle. And they even declined a 100 basis point cut in cash reserve ratio, which was not expected by the market. So we are having a very dovish monetary policy, and that is mainly because of the inflation behaving. Last month in May, for example, the CPI inflation came at lower than expected, 2.82%. So RBI had anticipated this and front-loaded the rate cuts. So we are not expecting any further rate cuts from the RBI, particularly in August.
So, VK, just put this all together and let's just get back to allocation and the playbook for fiscal second quarter and beyond. You're expecting a recovery in earnings. Are we going to see that recovery take place in the FMCG sector? And on a sector level, how then as investors should we approach retail and consumption?
Well, the recovery will certainly happen from the third quarter onwards. There are green shoots already happening there. Then we expect a very smart recovery in the banking segment. Banking segment has been doing exceedingly well. Earnings growth has been impressive, and there is valuation comfort also in the banking stocks. Market is not very, very fairly valued now. We feel that the market is a little bit, not I would say overvalued, but then valuations are higher than historical averages, elevated valuations, particularly in the broader market. Yes. But in financials, particularly in the banking stocks, the valuations are very fair. But in the first quarter and the second quarter results, banking stocks are not expected to do very well because there will be a compression in margins because of the rate cuts which have already been implemented. But the positive effects of the cut in cash reserve ratio will start flowing in from the third quarter onwards. Therefore, any dip in the banking stocks would be an opportunity to buy. That is one segment which is valued, fairly valued, I would say even attractively valued in the market, which is otherwise having elevated valuations. FMCG is not very attractively valued. Historically, it has been, having a premium valuations. But then in the context of the recovery there, we can expect improvement. Already the market is slowly discounting the recovery in the FMCG segment. The other domestic consumption themes that I said earlier, particularly telecom, aviation, and hotels, and also construction to a large extent, are expected to do well.
I'm glad you mentioned that, VK. So a debutant like travel food services that is highly leveraged towards the entire hospitality and the travel and tourism theme in India, which is holding up quite well to all intents and purposes. Is that an area, is that a name that you like?
Yes, that is an area which we like, and that also is a name that we like. But then, as I said, in IPOs, the concern now is valuations. Our retail investors are a little bit irrationally exuberant these days. Therefore, they are just buying all the IPOs irrespective of valuations. So we have been advising the retail investors to be more careful about the valuations when they apply for IPOs.
Yes. Prudence is the watchword. And VK, do you think that they are getting over their skis when it comes to the F&O market as well? And was Jane Street something off a warning shot fired by the regulators and really telling the retail investors, just, watch what you're investing in, do your homework and do your due diligence? Do you think there are more Jane Streets to come, or do you think SEBI and the regulators are now ahead of the curve in terms of potential foul play and market manipulation concerns?
Yes, we think the regulator is ahead of the curve now, because the response to the Jane Street episode has been very prompt and very harsh also. And SEBI has alleged intraday index manipulation by Jane Street. And therefore, that their action also is very much welcomed and desirable. But then ultimately investors, it's not investors actually, it is traders. We had an explosive growth in the number of demat accounts in India after the COVID crash of 2020. In early 2020, we had around 40 million demat accounts. Now it is 200 million demat accounts. There has been an explosive growth, and a large number of these newbies in the market, driven by, excuse me for saying this, driven by greed and ignorance, has been chasing the F&O market and has been losing money. The regulator and most seasoned market players have been advising the retail trade investors not to trade in the market. They should be focusing on investing in the market, but they have been trading quite a lot and losing a lot of money. And therefore, this warning shot from SEBI is very much on the right lines, and we expect more action from the SEBI on these lines.
VK, do you fear, though, that there could be more Jane Streets waiting to fall out of the closet, or do you think that the regulators have effectively closed that loop now?
We don't know whether there are any more Jane Streets waiting to fall out of the cupboard. But this is a preemptive action. It will be a very serious warning for potential traders. In the language of SEBI, the manipulators in the market who are manipulating using their money muscle.
Understood. VK, let's get back to the sectors. And we got some bad news last week with TCS, and they're very exposed to the growth cycle, to the cyclical headwinds, to tariffs, and we saw enterprise demand somewhat falling off. Is it going to be a similar story with HCL Tech? And broadly, how would you describe valuations in IT services? And selectively, how do we approach this area of the market?
HCL is likely to, post slightly better results than TCS, but we are not very sure about that. But then for an industry which is growing in single digits, industry with a revenue growth of single digits, it is not very much reasonable to give valuations above 22 times. 22, 23, 24 are the valuations for the large cap IT names like TCS, Infosys, Wipro, and HCL Tech. But we have better growth in mid-cap IT names. They are not very much impacted by the slowdown in the US. Therefore, mid-cap IT names like Coforge, Persistent Systems, Hexaware Technologies, etc., are expected to post better results. And there is more valuation comfort in this mid-cap segment, given their growth potential.
Understood. VK, my final question is about the trade deal. A lot of sectors are watching this very closely, from the autos to pharma, IT services. Is an early harvest or a mini deal the best that we can expect? And how confident are you of a full and final deal, the so-called deal by Diwali around September, October time? And what are the implications then for market pricing?
We expect a mini deal very soon. President Trump himself has gone on record saying that US and India are close to a deal. But with the President Trump, no one can be very sure. So we'll have to wait for the details of the deal. We expect a deal with the US with a tariff rate of around 20%. That is the expectation now. But we are unlikely to give any concession, particularly on the dairy industry. The dairy industry in India is not a large commercial industry like in the West. It is not a commercial activity. It is a source of livelihood. It is a way of life for millions of small farmers. And the Indian government cannot afford to wreak havoc with the livelihood of millions of small farmers. So there is unlikely to be any compromise on that front. But in other areas, since India is having a trade surplus with US, we can give concessions in other areas like importing more, oil and gas from US, having a better purchase on defense deals. Those are the areas where US and India can strike a deal.
Indeed. VK, always great catching up with you, sir. Thank you very much indeed for those insights on the market and the market outlook. Thank you, sir. VK Vijay Kumar there from Geojit Financial Services. Let's take a look at Bitcoin. Once again, it's now crossed the 120K mark and hitting a fresh record high. Just in the last 1 year, cryptocurrency is up nearly 100%, just in terms of context. Now, Indian markets have joined the trading day, and we will bring you some key earnings and other stories that we are watching today. After this short break, we are back in 2 minutes. Welcome back. You're watching Inside India. Before we get to the market open, some of the other stories we're keeping tabs on. President Trump attended the FIFA World Cup final on Sunday in New Jersey. The British press say that he gate-crashed it, presenting the trophy to Chelsea after their 3-0 win over Paris Saint-Germain. Trump, who was accompanied by FIFA President Gianni Infantino, was greeted by widespread boos as he appeared on the stadium boards. Just last week, FIFA announced that they opened an office in New York's Trump Tower ahead of the 2026 World Cup, which the US is set to co-host with Canada and Mexico. China's Foreign Minister Wang Yi met his Russian counterpart Sergei Lavrov in Beijing on Sunday. The two discussed their relations with the US, Iranian nuclear issue and the prospects of ending the war in Ukraine. China says the meeting was to, quote, jointly respond to challenges brought about by a turbulent world. Lavrov is in China to attend a meeting of the Shanghai Cooperation Organization's foreign ministers. Qatar Holding has become the third largest shareholder in China Asset Management after taking a 10% stake in the company. China AMC's two other major stakeholders are CITIC Securities and Mackenzie Financial. Qatar Holding is a subsidiary of Qatar's Sovereign Wealth Fund and is the latest instance of Middle East capital flowing into Greater China markets. Back to India in the meantime. The Indian markets are just joining the trading day. This is what the benchmark is doing. It's crossed 25 actually, but still it is down by about, let me rephrase that, it's holding above 25,000 but down by 0.3%. Let's give you the exchange rate as well while we're at it. It was at 86, but now we've seen a little bit of paring back from that level, still pivoting around the 86 handle, 85,956. So that means the dollar is in the box seat against the Indian rupee, which is weaker to the tune of just a marginal 0.2%. Oh, remember that inflation data this week from India will be an important mover for the Indian rupee, potentially, what it portends for the RBI come early August, which is when they hold their policy meeting next. Right, the latest in the Jane Street case. The US trading firm has deposited $567 million as required by the Indian regulator in an escrow account. That's according to India's money control. While this means SEBI would allow it to resume trading activity in the Indian marketplace, it's unclear if Jane Street will do so. Let's take a closer look at some of the movers in the Indian markets today. Avenue Supermarts, the operator of D-Mart, posting a slight dip in first quarter profit as rising operational costs and stiff competition from quick commerce players like Zepto and Blinkit squeezed margins. Net profit for the June quarter slipped to 7.73 billion rupees, despite a 16% rise in sales. The retailer cited wage inflation and intense competition in the consumer goods space as key challenges as it continues to battle fierce competition from rivals Reliance and Vishal Megamart. The stock down by almost 2%. VIP Industries has announced that Chairman Dilip Pirumal and his family will sell up to 32% of their company's stake to Multiples Consortium. The deal will open an offer under SEBI's takeover regulations. Once the deal is completed, this will transfer control of VIP Industries to Multiples Private Equity. The Pirumal family will remain shareholders of the firm, with Dilip Pirumal taking on the role of chairman emeritus. An e-scooter maker Ola Electric will also post its Q1 earnings today. Shares are slightly softer at 39.74, but troubles are mounting ahead of that report card. The state of Maharashtra has ordered the closure of 90% of Ola Electric stores, one of its biggest markets. About 450 showrooms will be shut down because the company does not have permission to store unregistered vehicles. Western State accounts for roughly 12% of Ola's total sales. And Germany luxury car maker Mercedes-Benz has posted record first quarter sales in India, up 10% to 4,238 units, driven by strong demand for its premium models and electric vehicles. India's growing appetite for luxury cars has surged with rising incomes and a younger customer base. Top-end models like the S-Class and Mercedes Maybach jumped 20% last quarter, while EV sales more than doubled, now making up 8% of Mercedes sales in India. Mercedes remains the luxury market leader in India, ahead of BMW and Jaguar Land Rover. All together now, as Janis Joplin famously sung, "Oh Lord, won't you buy me a Mercedes-Benz?" I could do the whole song, but I don't think we have the time. But anyway, moving swiftly on. Tomorrow, we will do a deeper dive into the India EV story as Tesla opens the doors of its first showroom in the country. We'll have all the latest from there. Make sure to tune in. Right, that's all the time that we have today on Inside India. I've spared you my bad singing. Do keep watching CNBC. Dan Murphy is up next with Access Middle East.